Welcome back to the Deep Dive. We're here to take those dense corporate earnings calls and, well, distill them into the essential intelligence you need.
We turn hours of management speak and spreadsheets into something clear, something you can actually use.
And today, we are definitely diving deep. We're looking at the retail giant, Target, ticker TGT.
Yep. This is our breakdown of their Q3 2025 earnings call. It happened just before the market opened back on November 19th.
And the lineup for this call was pretty significant. It really felt like a key moment for them.
For sure. You had the outgoing CEO, Brian Cornell, on his last scheduled call.
Right. And then you have the incoming CEO, Michael Fidelk, plus the CFO, Jim Lee.
So what we're really trying to unpack for you here is this core tension. Target is doing some phenomenal things internally, operationally.
That consumer's just not playing ball. The top line is soft.
And that tension is exactly what drove the market reaction. I mean, it was immediate skepticism.
Shares were down. What was it?
Nearly 3% at the open. And on volume, that was more than double the average. So investors were clearly focused on the negatives, despite, some really impressive internal performance.
Okay, so let's get right into that initial snapshot. Give us the hard numbers that spooked everyone.
Certainly. So on the surface, the bottom line looked okay, a small win even. Adjusted EPS came in at $1.78.
Which beat consensus.
Right, it beat the $1.72 expectation by 6 cents. That's solid execution.
But as always, the top line told a much different story, a more anxious one.
Exactly. Revenue was $25.27 billion, a slight miss against the $25.32 billion consensus. But the real story is that net sales were actually down 1.5% year over year.
And the metric that the market really grabbed onto, the one that's driving this whole turnaround narrative, was comparable sales.
That's the one. That's the metric that really drove the negative feeling. Comps, as they're called, were down 2.7%.
And this isn't a one-off thing.
No, not at all. This marks the third straight quarter of negative comps. It suggests this consumer pullback isn't just persistent, it's really settling in for a while.
Okay, so if comps are down 2.7%, we need to know why. Are fewer people shopping, or are they just spending less when they do show up?
It was a bit of both, but traffic was definitely the main problem. Overall, store comps were down a pretty steep 3.8%.
Wow.
Yeah. And breaking that down, traffic itself, so just the number of visits, was down 2.2%. And the average ticket, how much people spent, was also down 0.5%.
So people are being cautious, they're hunting for deals, but they're also just walking into the stores less.
That's the takeaway. And you can see that caution reflected in what they're buying.
Where are they stretching those budgets?
Well, the divergence is pretty stark. The necessities, they're holding up. Management said they saw positive comps in food and beverage.
Makes sense.
And interestingly, also in hardlines, which they've sort of rebranded as Fun 101.
Fun 101, what's that?
Think seasonal decor, toys, trendy little gift items. Things that are maybe an affordable treat when you can't splurge on something big.
But the real pain, I'm guessing, was in those big discretionary purchases.
Absolutely. The weakness just continues in apparel and home. The chief commercial officer, Rick Gomez, he actually mentioned apparel comps specifically were down 5%.
Ouch.
Yeah. I mean, they saw tiny bright spots in things like denim and sleepwear where they brought in new stuff. But the overall trend is clear. Big wardrobe refreshes are on hold.
Okay, so that paints a really clear picture of a weak consumer. But the operational side of this is where Target, frankly, kind of shined.
It really did.
They were throwing promotions and markdowns at people to get them to buy, but their margins held up way better than expected.
Yeah.
How did they pull that off?
This is the operational masterclass that the market seems to be ignoring because it's so fixated on comps. The gross margin rate only dipped 10 basis points. It landed at 28.2%.
Which is incredible given the discounting.
It's phenomenal. And it was powered by two really significant internal levers.
And what were those?
First, they had this huge growth in high-margin revenue from non-merchandise sales, specifically their retail media network, Roundel.
Roundel.
Roundel, plus marketplace sales and membership fees. That whole segment grew nearly 18%.
So just to be clear, Roundel is their internal ad platform. Brands pay Target to put ads on their website and in stores.
Correct. It's pure high-margin revenue, a massive structural tailwind for them.
So for every dollar they lose cutting the price of a T-shirt, they're kind of earning it back by selling an ad to the brand that made the T-shirt.
That's a great way to put it. And the second big factor was just internal efficiency. A massive, massive improvement from lower inventory shrink and supply chain costs.
What is shrink, Ann?
It's internal loss, theft, operational errors. And the CFO, Jim Lee, he guided that shrink improvements alone are expected to add 80 to 90 basis points of favorability for the full year.
80 to 90 basis points. That's huge. But is that a one-time cleanup or is it sustainable?
That is the right question to ask. Management insists they've made structural changes to security and logistics. If they're right, it's a permanent lower cost base. If they're wrong,
The margin pressure comes right back.
exactly. But it's also worth noting how volatile things were within the quarter. Sales were flat in August, that's back to school, and flat again in October, which was helped by Halloween and their big Target Circle Week sale.
So what happened in September?
A sharp decline. Net sales were down 4%.
It just proves that consumers are only buying when they absolutely have to or when there's a huge sale.
They are completely event-driven right now.
Okay, let's connect that pain point. The cautious consumer to management's really aggressive strategic response, because this is where the story gets interesting.
Very. The incoming CEO, Michael Fidelk, he's framing the whole turnaround around three priorities: merchandising, guest experience, and technology. And they are backing this up with an enormous amount of capital.
This is the part that really raised my eyebrows, the CapEx commitment.
It raised a lot of eyebrows, especially with demand so soft. They're ramping up their CapEx for 2026 to $5 billion.
$5 billion.
That is an extra $1 billion over what they spent in 2025. This money is going into store remodels, new stores, which are apparently doing very well, and a big upgrade to their digital fulfillment network.
That is a massive check to write when your sales are shrinking. Where's the immediate cash for this coming from?
They're funding a big piece of it through that internal restructuring. They're aiming to leverage about $180 million in annualized savings from cutting those jobs at headquarters.
The 1,800 roles, about 8% of their corporate staff.
That's the one.
Wait, so you're telling me they're cutting 1,800 people, a lot of institutional knowledge, to immediately help fund a $1 billion CapEx increase? Isn't that trading long-term expertise for short-term cash?
It absolutely introduces execution risk. It's a calculated bet. They're betting that the new technology they're investing in will make those roles redundant, allowing them to fund the growth engine.
So let's talk about that growth engine, the technology piece, because it sounds incredibly ambitious.
It really is. They're leaning hard into AI. They talked about their internal Gen AI platform. They call it the Target Trend Brain.
The trend brain.
The goal is to dramatically shorten that design-to-shelf cycle. If they can spot a trend, say a certain color or shoe style, and get it in stores in weeks instead of months, they can maybe start to fix that weakness in apparel.
That speed to market is everything in fashion. But the bigger tech news was that partnership with OpenAI.
The ChatGPT integration. That's a huge strategic move.
How so?
Well, Target is making itself one of the first major retailers where you can have a true conversational shopping experience. You can talk to an AI, build a whole shopping basket, including fresh food, and then pick it up at the store.
All without even opening the Target app.
Exactly. It creates this powerful new front door for the brand. It completely changes how you might discover items to buy.
And their internal logistics are being scaled up to support this.
Absolutely. Same-day services through Target Circle 360 grew over 35%. Their next-day delivery now reaches over half the U.S. population. That $5 billion in CapEx is designed to accelerate all of this.
And for the immediate future, the holidays, the strategy seems pretty clear. Newness plus affordability.
A dual play, for sure. They're introducing 20,000 new items, double last year's number, and over half are exclusive to Target.
But at the same time,
they're slashing prices on 3,000 everyday items and advertising a full Thanksgiving meal for 4 people for under $20. Come for the cool new stuff, but don't worry, we've got the value you need.
Okay, so we've got the operational wins and the aggressive forward-looking plan. But we have to ask the so what for the market. Why did the stock still drop? It all comes back to guidance.
The guidance was the anchor. Management narrowed their full-year adjusted EPS range, but crucially, they lowered the high end. It went from a prior $7 to $9 range down to $7 to $8.
And that trimming plus the cautious Q4 outlook.
Which is still projecting a low single-digit decline in sales. It just screamed uncertainty to investors. That wide range signals a lot of execution risk heading into the most important quarter of the year.
And it's not like Target has a ton of market goodwill right now.
No, they have a massive underperformance gap. Over the last year, the stock's price is down almost 29%.
29%.
Compare that to the S&P 500, up 12 to 14%, or even the Consumer Staples ETF, XLP, which is only down about 2 or 3%.
So the market is just treating them like a distressed value name, and it's fixated on those negative comps.
That's the core divide. Management sees this aggressive turnaround powered by $5 billion in CapEx and AI. The market just sees a stock chart that's broken and persistent weakness at the cash register.
They need to see proof that the savings from shrink and layoffs can actually translate into more people in the stores.
The catalysts to watch are holiday sales, the official CEO handoff in February, and any early signs of ROI on that big CapEx spend. Until then, the stock is stuck in turnaround territory.
All right, and now for the segment where we explore the fringes of market mechanics. This is not financial advice.
It is not.
Analyst, your moment. Based on all this, the skepticism, the investment, the internal wins, pitch us an outrageous but plausible contrarian trade idea.
All right. Given the brutal punishment the stock has taken and the clear disconnect between their operational wins and their stock price, especially relative to the safer consumer staples sector, I propose a high conviction pair trade.
Okay.
We're going long TGT and short XLP. That's the Consumer Staples ETF with an expiry in March 2026.
Long target, short defensive staples. That is a bold call on a 2026 recovery. Walk us through the rationale.
Okay, so the market has priced in sustained failure for Target, while the defensive sector, XLP, has barely been scratched. This trade is a bet on that $5 billion investment. We're betting that those high-margin tailwinds, like Roundell's 18% growth and the shrink recovery, start driving real margin expansion in 2026.
And the timing, March 2026.
That times it perfectly for their financial community meeting. That's when they'll detail the full 2026 plan, right after we see the critical holiday quarter results. If the turnaround is working, the stock could close that massive underperformance gap while you're simultaneously shorting a slower defensive sector priced for safety.
It's a conviction bet on the AI and logistics turnaround. A wager that the Target trend brain pays off faster than anyone thinks.
A highly leveraged hypothesis, yes.
So, to summarize this deep dive, Target is doing the right things internally. They're protecting margins, growing ad revenue, and investing a ton of money in AI and fulfillment.
But, and it's a huge but, they have not yet translated any of that into stabilizing their top-line growth. And that is why the market is holding its breath.
The entire story really does hinge on the next 3 months. We have to watch how their holiday comps perform against that cautious guidance. A surprise positive number could flip this whole narrative.
It absolutely could.
All right. And here's a final provocative thought for you to consider. Management said they are planning more changes to the store floor pad than they have in any year in the past decade.
Yeah.
Think about the massive scale of that physical change, combined with this new AI-driven personalization. The question is, how quickly can that combination of new-look stores and cutting-edge tech actually pull shoppers away from Walmart, Amazon, and the dollar stores, especially when everyone is so focused on value?
That's the $5 billion question, isn't it? This investment will either pay off spectacularly or go down as a massive missed opportunity. We've laid out the facts and the narrative from the call, but please remember, our analysis is for your information only.
We are not your financial advisor. Always do your own research.